You always hear about how important it is to understand investment risk,
Oh, yeah, for sure.
but I think a lot of people don't realize that not all risks are created equal.
You got that right.
I mean, some risks come with the potential for reward,
I call those the compensated risks.
and then some risks, well, they don't offer any potential reward at all.
Those are the ones you want to try to avoid.
Those are the uncompensated risks.
And one of the best ways to kind of steer clear of those unnecessary risks is through diversification.
That's the don't put all your eggs in one basket strategy.
Exactly.
So can you break down these two types of risk for us? What exactly makes a risk compensated?
Okay, so compensated risks, they're systematic, meaning they affect the entire market.
So it's not just one company or one specific industry. It's like a rising tide that lifts or lowers all boats.
Yeah, exactly.
Yeah.
And Denvers are basically rewarded for taking these risks on.
Because they're unavoidable.
Right.
If you want to invest in the market at all, you're going to be exposed to them.
So for example, market risk, the risk that the market as a whole could decline, that's a compensated risk.
Why is that?
Because historically, over the long run, the stock market has gone up.
Okay, so even though there are ups and downs along the way, if you're in it for the long haul, you're likely to come out ahead.
Yeah, the potential for higher returns over time, that's what compensates you for taking on that market risk.
Got it. Now, what about uncompensated risk? Those are the risks we want to avoid, right?
Yeah, you want to at least minimize them as much as possible.
So tell me more about those.
Well, uncompensated risks, they're idiosyncratic.
Idiosyncratic.
They affect individual companies or assets.
So it's not the overall market, it's something specific to that particular investment.
Right. And the good news is that a lot of these risks can be mitigated or reduced through diversification.
Okay, so give me an example.
Sure, like imagine you invest a big chunk of your money in a single stock, like all your money in one company,
Okay.
and that company goes bankrupt. Yeah, you could lose a big chunk of your savings, and there's no guarantee of a higher return to make up for it.
That's a risk I'd rather not take.
Exactly. That's uncompensated risk in action.
So how can we get better at identifying and avoiding these uncompensated risks?
Well, there's some interesting research out there that can help. Northern Trust did some analysis that really sheds light on this.
Oh, tell me about that.
Okay, so they looked at the performance of these active asset allocation funds. You know, the kind where the managers are trying to pick the best investments and time the market?
Okay, yeah.
And they compared these funds to benchmark portfolios that were based on a model called the ICAPM.
ICAPM, that sounds complicated.
Yeah, it stands for the Intertemporal Capital Asset Pricing Model.
That's a mouthful.
So it's basically a way of understanding the relationship between risk and expected return.
Okay, so it's a model that helps us figure out how much return we should expect for the level of risk we're taking.
Yeah, you got it. And the main factors that go into this model are term risk, which has to do with interest rates, and market risk, which is the overall market risk we were talking about earlier.
Okay, that does sound familiar.
And what Northern Trust found was that these two factors, term risk and market risk, they almost entirely explain the compensated risk you get in a diversified portfolio.
So even with all the fancy financial models and strategies out there, it really boils down to just those two basic risks when it comes to getting rewarded for the risk you take.
That's right.
Interesting. So what happened when they factored in all the other stuff that those active managers were doing? Like trying to time the market or pick specific stocks or sectors?
They called all that extra stuff the factor zoo.
Factor zoo. I like that.
So they basically added the factor zoo into the mix, and what they found was that it didn't really add anything to the recipe.
In fact, I think they found that it actually hurt returns, right?
Yeah, it kind of diluted the potential for getting returns that were higher than what those two basic factors, term and market risk, could explain.
So it's like trying to make a cake and just throwing in a bunch of random ingredients that don't belong.
Yeah, you're not going to end up with a better cake. You're probably just going to mess it up.
So trying to be too clever or too cute with your investments might not be the best approach.
And another key finding from their research was that most of those active asset allocation funds, they were actually under-diversified.
Meaning that they were taking on uncompensated risk that they could have avoided.
Yeah, which goes back to the importance of diversification.
Makes sense.
And this actually reminds me of a great article I read from the White Coat Investor.
Yeah, he talks about this stuff in a really clear and down-to-earth way.
He does, and he gives some really practical, real-world examples of how investors can end up taking on unnecessary risk without even realizing it.
Okay, like what?
Well, he talks about things like putting too much of your portfolio into a single stock, or even investing in bonds from just one company.
So becoming too focused on specific companies or industries can really expose you to uncompensated risk.
Exactly. He also talks about the risks of investing too much in real estate, but only in one specific geographic area.
Yeah, so if that area takes a downturn, your whole portfolio takes a hit.
Exactly.
What else does he mention?
Actively managed mutual funds.
Why are those risky?
Because when you invest in one of those funds, you're basically relying on the fund manager's skills to pick winning investments.
And there's no guarantee that they'll be able to do that right.
Right, you're taking on the risk that they might underperform the market.
Which is why so many people advocate for low-cost index funds.
Exactly. With an index fund, you're basically buying a basket of stocks that represent an entire market index.
You're not trying to pick individual winners, you're just capturing the market's overall return.
Right. It's a much more passive approach, and it helps to minimize those uncompensated risks.
Makes sense.
Now, the article does mention a famous quote from Warren Buffett. He said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing."
Oh yeah, that's a classic Buffett line.
So even he acknowledges that there are different approaches to investing.
And that some people might feel confident enough in their ability to pick winning investments that they don't feel the need to diversify as much.
But he's also saying that for most people, diversification is a good idea.
It protects you from making big mistakes.
Yeah, it helps to spread out your risk.
Right. And of course, this whole topic of diversification versus stock picking is a huge debate in the investing world.
I mean, some people swear by individual stock picking, while others are diehard index fund investors.
And I think the article even mentions that there was a big back and forth about this in the comments section.
Yeah, people get really passionate about this stuff.
It's one of those debates that never seems to go away.
And in the end, I think it really comes down to your individual circumstances, your risk tolerance, and your investment goals.
There's no one right answer for everybody.
Exactly.
They have to find what works best for you.
And that's where doing your research and understanding these concepts really comes in handy.
Yeah, helps you make more informed decisions.
That's the key.
Okay, so it sounds like the more we understand this difference between compensated and uncompensated risk, the better decisions we can make as investors, right?
Definitely. It's all about being smart about the risks you're taking with your hard-earned money.
I mean, it's not about avoiding risk altogether, is it?
No, not at all, because risk is inherent in investing.
But it's more about understanding which risks are worth taking and which ones you can kind of sidestep through diversification. This all makes me wonder, like, even if I thought I was good at picking stocks, would it even be worth the risk compared to just sticking with a more diversified approach, like investing in low-cost index funds? We actually got a great question from a listener about this. Her name is Sarah, and she's from Seattle. I'm in my early 30s, and I'm just starting to invest. Do I even need to worry about diversification at this point? Shouldn't I be taking on more risk to try to maximize my returns while I'm still young?
That's a great question, Sarah. And it's one that we hear a lot from younger investors.
Because conventional wisdom says that when you're young, you have more time to recover from losses, so you can afford to take on more risk.
Yeah, that's the general idea.
So what do you think? What's your take on that?
Well, it's true that time is on your side when you're in your 30s, Sarah.
You have a longer time horizon to kind of ride out those market fluctuations.
Right, and that might make you feel more comfortable taking on some additional risk.
I mean, we always hear about how younger investors should have a larger percentage of their portfolio in stocks, since historically stocks have had higher returns than bonds over the long run.
That's right. However, even when you're young, diversification is still super important.
Because you still don't want to be taking on unnecessary risk, right?
Exactly. Remember what we talked about. Uncompensated risk is unnecessary risk no matter how old you are.
So even if Sarah has a high risk tolerance, she shouldn't be exposing herself to risks that she could easily avoid through diversification.
Right.
So even if she decides to go with a heavier stock allocation, she should still make sure that she's diversified within that stock portion of her portfolio.
Exactly. So for instance, she could invest in a broad market index fund, like one that tracks the S&P 500, which holds a variety of different stocks across different sectors.
Okay.
Or she could even consider diversifying globally by investing in an international stock fund.
So this means that diversification isn't just about the types of assets you own, like stocks, bonds, real estate. It's also about spreading your risk across different companies, industries, and even different parts of the world.
That's a great way to put it.
And Sarah, as you continue to build your portfolio, remember that your investment strategy might need to evolve as your life changes.
For example, you might become a little more risk-averse as you get closer to retirement.
Yeah, you don't want to have all your money in risky investments right
Mhm.
before you need to start withdrawing it.
Right. And that might mean shifting your asset allocation to include more conservative investments like bonds.
Okay.
So investing is really a lifelong journey.
And it's all about finding that right balance between risk and reward for your own personal situation.
Exactly. And that balance can change over time.
So, Sarah, if you're feeling a little lost or unsure about what to do, it's always a good idea to seek out some personalized advice from a qualified financial advisor.
They can help you come up with a plan that's tailored to your specific needs and goals.
That's great advice. I feel like you've given our listeners a lot to think about today.
I hope so, because understanding the ins and outs of investment risk can really empower you to make more confident and informed decisions about your money.
Yeah, and just knowing that there are different types of risk out there and that some risks are worth taking while others should be avoided, that's a big step in the right direction.
Absolutely.
This has just been the start of the conversation, though.
Right.
I mean, there's so much information available on this topic.
And we really encourage everyone to keep learning and keep exploring different perspectives.
The more you understand about investment risk, the better you'll be able to navigate those tricky financial markets.
And hopefully achieve those financial goals you've set for yourself.
Exactly. This whole concept of compensated versus uncompensated risk, it's really been eye-opening for me.
It's one of those things that once you see it, you can't unsee it.
Yeah, it's a really powerful framework for understanding how the market works.
It really emphasizes just how important it is to be intentional about the risks you're taking with your investments.
So to wrap things up, what's one key takeaway you'd like our listeners to leave with today?
Well, I'd say don't let fear paralyze you from investing altogether.
Right. I mean, you have to take some risk if you want to see returns.
Exactly. But on the other hand, don't let overconfidence blind you to the very real risks that are out there.
So find that balance.
Right. By understanding the different types of investment risk and how they can affect your portfolio, you can make more informed decisions that are aligned with your financial goals and your risk tolerance.
And if you're not sure what to do, don't be afraid to ask for help.
Yeah, there are plenty of qualified financial advisors out there who can help you create a plan that's right for you.
Great advice. This has been another fantastic deep dive. I always learn so much from these conversations,
It's been a pleasure.
and I hope our listeners feel the same way. So until next time, keep learning, keep growing, and keep diving deep into the world of finance.
See you next time.